Hello, everyone. My name is Chris Huntsman. I'm the Director of Internal Sales for OneAmerica. Today, we're specifically going to be talking about our recurring premium asset care solution, which is a whole life-based approach for long-term care. You should be able to download a copy of the webinar slides from GoToWebinar control panel on your screen. But if you have any issues pulling those off, feel free to just email me at Chris Huntsman, or it should be chris.huntsman@oneamerica.com. Also, if you forget that email address, you should get an email after the webinar today, an automated email from me. So just reply to that email and let me know that you need the slides. All right, so before we get started here, we'll give compliance there a moment in the sun here. I'll assume you're all speed readers. All right, so first, for our deep dive into recurring premium asset care, we'll get into an overview of the recurring premium version of asset care. So I'm not going to be touching on the other funding options for asset care, just going to focus on the recurring premium option today. First thing we'll do is we'll go into a product overview of it. So we've been selling asset care since 1989. However, the recurring premium version of asset care debuted in 1994. So this version is kind of a great opportunity for people who need long-term care protection, but maybe they don't have that liquid lump sum they can move at the time, but maybe they have a good income stream. Now, asset care is a whole life policy, so premiums cannot increase. It has cash value growth, and loved ones receive a death benefit minus any LTC claims paid out. Now, there's also some creative ways you can fund a recurring premium policy, so I'll kind of offer up some different sales ideas of ways to kind of fund an annual pay asset care to kind of get that creative juices flowing. So if you run into a client that has, let's say, a two-tiered annuity, like the type Allianz offers, a lot of them are worth more to a client if they annuitize the annuity. But the problem is most people never annuitize their annuities because they don't want to give up the cash value for an income stream they don't need. So it might have a cash value of, let's say, on this two-tiered annuity of like $60,000, but maybe it's worth $120,000 if they annuitize. Well, you could annuitize it as a 10-pay, so do like a 10-year certain income stream to get the full value out of it, so get that full $120,000 value out of it that you wouldn't get if you just cashed out, and then have those 10 payments on that 10-year certain income stream fund a 10-pay asset care. So you're giving up the cash value of the annuity, but you're recapturing the cash value in the asset care policy, all while creating leveraging in two places. And the same thing would apply to turning on income riders for both variable and indexed annuities to fund an asset care policy. Once again, get that full value out of those old annuities. So basically double down on your leveraging opportunity by getting leveraging from the income rider, but also leveraging from the asset care policy. All while you're getting that cash value, once again, that you gave up on the annuity, you're recapturing it in that life policy. Also, maybe you've got clients who are just kind of starting to turn on pension or Social Security income that they don't really need in retirement. That can also be kind of a good sales approach to have those dollars fund a recurring premium asset care as to not touch the client's other assets. So now what I want to do is kind of take a look at just kind of the product specs. So kind of jumping into the product specs, this is going to be the product specs specifically for the recurring premium asset care. So issue ages are age 35 to 80. On a joint policy, just so you're familiar with it, on a joint policy, both insureds would have to be between the ages of 35 and 80. Now, the minimum death benefit is $50,000, barring a specific state that requires a higher death benefit. And then the payment duration can be either a 5-pay, a 10-pay, a 20-pay, and then we also have a pay to age 95. Now, for payment modes, we can do an annual pay, a semi-annual, quarterly, or a monthly bank draft. Now, one key point with this is, however you set up the base life policy premium duration and mode, you have to have the same duration and mode for the attached riders. So if you have a 10-pay life policy, any riders you add on, like the continuation of benefits rider, would also have to be a 10-pay. Now, if you do a quarterly pay life policy, once again, any riders you add on would have to be a quarterly pay as well. So we want to make sure that the insured doesn't miss a payment because, or the owner, I should say, doesn't miss a payment because, one part of the policy was on a separate payment duration or mode than the other. So we want to make sure everything's crystal clear, everything's due at the same time. Now, kind of continuing on with the product specs for recurring premium asset care, we can add on an optional continuation of benefits rider, which we refer to as a COB rider. So once again, just stands for continuation of benefits. So that COB rider continues the long-term care benefits after the base life policy has been exhausted for long-term care benefits. we can actually add on that COB rider to be a lifetime benefit. So we're actually the only asset-based long-term care solution in the market with the ability to cover that catastrophic risk of a long LTC claim. And remember, the whole reason insurance companies exist is to protect clients from that catastrophic risk. We actually have a client currently in her 16th year of claim with us. So kind of imagine if she did not purchase the lifetime benefit rider. It'd be probably an awful situation where she's dwindling down all of her assets and probably in a Medicaid bed at this point if she didn't have that lifetime benefit coverage. Also, waiver of premium is automatically included on all premiums associated with the policy, and it simply works that if any insured, so if it's a joint policy, if either insured is receiving long-term care benefits from the policy, all premiums associated with the policy are waived. So at no time would you be receiving benefits, but also paying any type of premium for the policy. So it's a full, true waiver of premium for all parts of the policy if either insured is receiving benefits from either the base life policy or from the rider from a long-term care perspective. Now lastly, asset care can be set up with a single insured or with joint insureds. On a joint policy, both insureds have 100% access to that long-term care benefit pool that's created by the life policy and that continuation of benefits rider. So we're not forcing them to have to split the pool. It's both of them have 100% access to that pool for long-term care. So now what I want to do is I kind of like to take some time comparing asset care to standalone traditional long-term care insurance. So since asset care's debut in 1989, there's really only been minor enhancements that have been made to it. In that same time frame, standalone long-term care insurance has had significant changes. You've seen companies that have exited the traditional long-term care market and enforced traditional long-term care policy premiums have escalated due to premiums not being fixed and receiving rate hikes as well. Increasing premiums have caused a lot of financial stress on a lot of policyholders, leading them to either discontinue policies or reduce their LTC benefits dramatically to be able to continue those premium payments at the same rate. Now, the reason asset care hasn't had those same issues is that traditional long-term care policies, they weren't sold as a high deductible plan like what we do here at OneAmerica. And the reason we call it a high deductible plan is because you're going to spend on that life policy first before you get into the continuation of benefits rider. And the continuation of benefits rider really acts more like your catastrophic insurance coverage. So it's kind of like the life policy acts like your HSA or your health savings account that you spend on first before that catastrophic long-term care insurance, which is the lifetime benefit rider, kicks in afterwards. So just like your homeowners or your car insurance, kind of think of it comparing to other types of insurance, the bigger your deductible, the more affordable your catastrophic insurance coverage is. So once again, that deductible being the life policy that you spend down first. So we've just kind of taken that same high deductible catastrophic insurance coverage that a lot of affluent people use with car insurance, homeowners insurance, medical insurance. We've just taken that same approach to long-term care. So continuing kind of our comparison of asset care to standalone long-term care insurance, let's kind of examine a single insured policy on an asset care and then also on a traditional long-term care insurance policy. And for this example, we're just going to kind of use a 55-year-old female. For the traditional long-term care numbers, we are using a well-known and market-leading LTC company, but I'm not going to name them. Even if you email me, I'm not going to name them. So for both policies, we're going to use a $5,000 per month LTC benefit. For asset care, you can see we've done a 50-month policy using a 25-month base and a 25-month COB rider. And the closest comparison for traditional long-term care insurance would be like a 48-month or a 4-year policy. Now, the elimination period for asset care is 0 days for home health care and 90 days for all other types of care. Now, one thing I do want to note, if you're in home health care for 90 days, that will meet your 90-day elimination period for all other types of care. So it is possible you would never have a single elimination day. Now, for a standalone policy, I did run the quotes that I ran, I did run them at 60-day elimination period to kind of be in between the 0 and the 90 days for our product. Now, both policies have waiver premium, but only the asset care policy has guaranteed premiums. So that traditional LTC policy could have rate hikes as years go by, so keep that in mind as we continue to talk about the numbers. Now, at the end of year 10, asset care has a cash surrender value in this case, and it has a cash surrender value of $19,033. And then in year 20, you'll see that it's grown to a cash surrender value of $48,206. Now, obviously, with the traditional long-term care policy, there's no cash value at any point. Now, with Asset Care on this setup, we would have a $125,000 death benefit on a first to die, since it's only a single insured person, and then the traditional long-term care policy would have no death benefit. Now, the total annual premium for the Asset Care policy, as you can see, would be $4,119 per year at a guaranteed rate that can never increase. Now, the traditional LTC policy would run $2,453 per year, but without a guaranteed premium. Now, obviously, at first glance, it appears the traditional policy costs less. However, if we consider the cash value, things look a little different. If we were to take that cash surrender values from year 10 and 20 that you see on the slide, if we take those into consideration and kind of net those out, if we were to cancel the policies in year 10 or 20, that changes the story. What you'll see is in year 10, if we were to net those costs or net that cost with that cash surrender value and then annualize that, the Asset Care would actually only cost $2,215 per year. And then if we took that out to year 20, it would only cost $1,706 per year for that Asset Care policy, both of which are going to be less than that cost for that standalone policy. And remember, that's even if we assume the traditional long-term care policy premium staying flat over the course of 10 and 20 years, which is probably unlikely to happen. So taking into consideration that cash surrender value, and if we were to annualize that net cost, we find that Asset Care costs less while providing a death benefit, a fixed premium, and 2 additional months of long-term care coverage for this client. So now let's kind of take a look at a joint policy comparison. Now, obviously, we can't do a joint policy for the standalone traditional LTC policies. So what I did there was I did 2 policies, each with a spousal discount for those, while I did a joint policy for Asset Care. Now, this couple is going to be 55 years old, male and female. We solved for that same $5,000 per month benefit per person. For Asset Care, we did a 33-month base policy with a lifetime benefit rider, giving each insured an infinite pool for long-term care they can never outlive. And then for the traditional long-term care policies, we did a 6-year benefit for each. Now, the elimination period and waiver of premium options we ran on the previous slide remain the same here. Once again, Asset Care has guaranteed premiums, while that traditional long-term care policies do not and could have rate hikes. Now, at the end of year 10, that cash surrender value of Asset Care is $23,432. And at the end of year 20, it's grown to $62,248. Now, once again, that traditional LTC policy is not going to have any cash value. The death benefit for Asset Care in this scenario is going to be $166,667. Now, that would be on a second to die basis, so that death benefit wouldn't pay out until the second death. And then the traditional LTC policy, once again, would have no death benefit. Now here, the total annual premium for the Asset Care policy would be $6,685 at, once again, a guaranteed rate never to increase. And that traditional long-term care policy would run $3,870 per year, but without a guaranteed premium. The traditional LTC policy would cost less per year, but once again, we need to take a look at that cash surrender value to get that full picture. So if we were to take the cash surrender value from year 10 and 20 into consideration and net those out, if we cancel the policies in year 10 and 20, you'll see the premiums are really close. You'll see in year 10, the net annualized cost for the Asset Care is $4,341 per year compared to $3,870 per year for that traditional LTC policy. And I'm willing to bet most people would agree that it would be worth an extra $500 per year to get fixed premiums, a death benefit, cash value, and a lifetime infinite pool for long-term care you could never outlive, versus having a 6-year policy with none of those other benefits. Now, if we look at year 20, it would be a net annualized cost of $3,572 per year compared to $3,870 for the traditional policy. And once again, that's if we assume the traditional LTC policy premium stays flat over the course of 10 and 20 years, which once again is probably not likely. Now, with a lot of life insurance sales since the 1980s, the live, quit, or die approach is used when kind of walking a client through the benefits. And that approach works with Asset Care as well. So you can guarantee one of those 3 things is going to happen while they own that contract. Either the client's going to live too long and need long-term care, they're going to quit the contract, or they're going to die with the contract in place. no matter which of these three things happens, Asset Care is going to pay out. So now I want to kind of take a look at how Asset Care might work in all three of those scenarios. So once again, that live, quit, or die approach. So first we'll kind of start with what happens if the client dies without needing long-term care benefits. And here on the screen is the ledger page of an actual illustration for a joint quote. Through the next few slides, we're going to follow this couple as an example. So this couple is a 55-year-old couple, non-smokers, male and female. They have a base life policy death benefit of $166,667 with a base policy coverage for 33 months and the continuation of benefits rider for a lifetime benefit. Now, we've also added 3% compound inflation protection to the rider portion of the policy for 20 years worth of growth. As you can see, the base policy in the COB rider costs $87.20 per year in premium. If the clients die at age 75, over 20 years, their Asset Care policy has cost them $174,400. Now, if you subtract the $166,667 death benefit paid by Asset Care, the client has spent $7,733 above the death benefit. So if you kind of annualize that amount, it means they paid $387 per year to cover two people with a lifetime benefit of $5,000 per month per person, growing at 3% compound inflation for 20 years. That is extremely low cost LTC insurance you're just not going to find anywhere else, especially with these kind of benefits like lifetime benefits. Now, if we were to price out that same policy for traditional long-term care and assume no rate increases, that total cost of the clients would have been $133,734 over the course of 20 years. So even if we don't take long-term care benefits into consideration, the Asset Care policy nets them nearly $126,000 more in their pockets over 20 years than the standalone traditional LTC insurance did, which typically does not offer a death benefit or cash value. I'll kind of pause here a second so people kind of absorb the information on the slide here a little bit more. So now we'll kind of see what it would look like if the clients quit the contract. So if your clients decide the long-term care benefits are not for them, they can get some of their money back. So on your screen, you're seeing the ledger page from the same scenario on the previous slide of those two 55-year-olds. In the circled column labeled cash surrender value, you're going to see the dollar amount they get back in any given year if they were to surrender the contract. Now, I recommend when walking clients through this page to kind of annualize that total net cost like we did when we did the comparison versus standalone LTC insurance on a previous slide. So for example, if the clients are paying that $87.20 per year for the life policy and the lifetime benefit rider, in 20 years, they've spent that $174,400. If we subtract the cash surrender value in year 20 of $62,248, we'll get the total cost over 20 years, which in this case would be $112,152. If we then divide by the 20 years they paid premiums, that gives us an annualized cost of $5607 per year. So I kind of like to joke with clients, Asset Care is a rare insurance that costs less over time. So the longer you own it, the less it's going to cost you. An additional thing I like to point out, people rarely quit these contracts. Asset Care actually has a 98% retention rate. So I hope you're starting to see why as we kind of talk through all the different benefits and all of the triggering methods you can get benefits out of the policy. So now what I want to do is kind of see what it would look like if the clients live too long. I know it's probably a good problem to have. And let's say they need long-term care using the same example of those two 55-year-olds. So if we use this example and assume this couple needs catastrophic coverage, we know they're covered due to including that lifetime benefit rider that creates that infinite pool for long-term care they can never outlive. So now let's look at that monthly benefit rider and what it creates growing at that 3% compound inflation. So if the couple is 55 now and they need catastrophic coverage starting at age 75, each one's going to have $5,000 per month during the base policy and $8,768 per month from that lifetime benefit rider. Now, one important note, the monthly benefit is per person. So each client could pull that $8,768 per month from the rider at the same time. So bad car accident, they're both in claim. he could get $8,768 per month. She could get $8,768 per month. So I always want to make sure we're clear that that monthly benefit you see is per person. All right, so let's do a little math to take this a step further. So this couple paid $8,720 per year, and they're 20 years into their coverage. So they've paid, once again, that $174,400 of cost. In the 20th year, if either insured went on claim for 3 years, we would pay out $191,304. Now, if either insured had an average Alzheimer's claim of 8 years, that would be a payout of $733,164. And to really show how powerful this policy would be, if just one insured had a catastrophic 20-year Alzheimer's claim, it would pay out just over $2 million. And don't forget, all these LTC benefits are paid out income tax-free. So huge leveraging opportunity, especially if they have that, God forbid, they have that catastrophic 20-year type claim with Alzheimer's. So not a bad return on investment. If you put $174,400 into something, you got $2 million plus out of it. Well, that's really it for today's deep dive into recurring premium asset care. I hope you kind of saw a different way to look at things on that live, quit, or die, and different ways that you might look at what the total cost of it something actually was versus what they paid out of pocket when you consider like the cash surrender value and things that go into it and the death benefit. So thank you everyone for attending today's webinar. Once again, if you have trouble downloading a copy of today's webinar slides, please let me know via email at chris.huntsman@oneamerica.com. Hope you all have a great weekend. Thanks for attending.